You've made it to part 4. Great to have you here as we explore how to make the ECL process smarter and smoother through automation and data-driven methods. By now, we've established what needs to be done and how to do it manually. Now, let's talk about working smarter, not harder. I want you to imagine it's the next financial close. Instead of poring over spreadsheets, you open up a dashboard that shows your receivables data already segmented with loss rates applied and even an option to toggle economic scenarios. With a few clicks, you refresh the calculations and see the updated expected credit loss figure. All the heavy lifting, the math, the data pulls, the version control handled by a system. This isn't a fantasy. This is what automation brings to the table. Why is this such a big deal? Well, as we discussed, calculating ECL can get complicated. When humans are in the weeds of complex calculations, mistakes can slip in. We've all been there. One wrong formula or an outdated link in Excel can throw off results. Automation drastically cuts that risk. A purpose-built ECL tool will have the logic coded in, no formulas for you to accidentally overwrite. It will also ensure consistency. Every receivable is treated according to the defined model, no exceptions unless you explicitly make one. Now, let's talk about audit readiness and transparency. An auditor's dream is to see a clear trail from raw data to final financial statements. Automation helps make that a reality. A good ECL system will log who changed what and when. Did someone update the GDP forecast assumption? The system notes it. Did we add a new customer segment this quarter? It's recorded. So when auditors or regulators come knocking, you can generate a report that shows the entire ECL computation flow. This not only makes their job easier, it also makes your life easier because you're not scrambling to recreate how you ended up with a particular number. Consider also how automation enables speed. Under traditional methods, if the board asks, can we see what happens if the economy contracts by 1% more than your base case? The finance team might groan. That could mean hours of reworking spreadsheets. But with a robust model in a system, you can input that scenario and get results in minutes. The agility to perform scenario analysis is invaluable. It transforms ECL from a static compliance exercise into a dynamic risk management tool. Management can make more informed decisions. For example, maybe they decide to tighten credit terms after seeing a worst-case scenario outcome on the allowance. Another angle is data integration. Automation often comes with the ability to connect different data sources. Your ECL system can pull data from your billing software, your CRM, and even external economic databases. This means your model can be fed timely data without manual intervention. If, say, you add new sales that create new receivables, those automatically flow into the ECL calculation. If a central bank revises an interest rate forecast and you subscribe to a data feed that could flow in as well, it keeps your ECL model alive and in sync with reality. Let me share a quick anecdote. A CFO of a mid-sized manufacturing company once told me how adopting an automated ECL tool was a game changer. Before, the ECL process was a quarterly fire drill. Several analysts would spend days compiling ages, writing macros, checking and rechecking numbers. It was stressful, and they still worried about errors. After automation, the core calculation went from days to a few hours. The team then spent the freed up time analyzing why the allowance moved quarter to quarter, preparing a crisp report for the audit committee with real insights. Receivables from our retail segment show increasing risk. We've increased the provision there. Perhaps we should tighten our credit policy for that segment. In essence, they shifted from number crunchers to business advisors. That's the power of leveraging technology. Now, I know what some of you might be thinking. This sounds great, but can we afford it? Is it worth investing in a tool or system for this? It's a fair question. The answer will vary, but consider the cost of not having a reliable process, potential misstatements, audit fees for extra work if things are unclear, or even penalties. And the less tangible cost, the opportunity cost of your team's time and the stress involved. In many cases, especially for companies with significant receivables. The investment in an ECL solution pays for itself relatively quickly through efficiency gains and risk reduction. Finally, let's touch on the future. Data-driven models. We're in an era where data is king. Companies are starting to use more advanced analytics for all sorts of predictions, including credit losses. Machine learning models can analyze patterns, perhaps combining financial history with behavioral data like payment patterns or even email communications with clients to predict defaults. While these are cutting edge and may be more relevant for banks, it's likely that over time such techniques will trickle down to corporate credit management as well. But even as models get sophisticated, the need for governance remains. Any model, whether a simple provision matrix or a complex AI algorithm, must be well governed. Automation helps enforce that governance by providing structure and documentation. As we wrap up, the message is embrace technology in your ECL process. It's becoming the norm, and regulators implicitly expect companies to have control over these calculations, something that's hard to achieve at scale without the help of software. Automation doesn't replace our judgment, it complements it. This brings us to the end of our series on expected credit loss provisioning for trade receivables. We've journeyed from understanding regulatory expectations through the risks of not complying into the nuts and bolts of doing it, and finally how to make it efficient and robust. I hope you found these sessions informative and useful. ECL provisioning might seem like a technical topic, but it really does safeguard our company's financial integrity and let stakeholders sleep better at night knowing there are no nasty surprises hiding in the receivables. Thank you for joining me.